So today, I'm with my friend and fellow Keller Williams agent, Greg Carlson.
Howdy.
Greg, thanks for coming out today.
Thanks for having me.
We're going to talk about the Austin real estate market because there's a lot of theories about what's going on out there, but Greg has a unique perspective. He's kind of like me. He does a lot of research, trying to understand what's going on. But let's just kind of like hash this out and kind of get a feel for what's going on.
I like it. I like it. Okay. So whenever I talk about market stats and real estate to anybody, I typically like to reiterate the fact that there's two asset classes throughout American history that have outpaced inflation, okay? One is the S&P 500, and two is real estate, right? And with that being said, outpaced inflation, it's gonna have its ups, it's gonna have its downs, right? Wouldn't you say? It's got its ups and downs.
Yeah, everything.
2008, right? That was a big down,
yeah.
right? Well, we haven't necessarily seen an actual down like 2008 since then. But what I've noticed is these hard stops. Whereas last year it was July 4th weekend. Do you recall that last year?
Well, let me ask you this. What do you mean when you say hard stops? Are you talking about kind of like buyers putting on the brakes?
Putting on the brakes.
Exactly.
Buyers putting on the brakes, right? Things are flying off the shelf 1 minute, literally July 4th weekend, crickets.
Gotcha.
And then this year was Memorial Day weekend.
Okay.
When things took a shift.
Yeah.
At least that's the general consensus.
Well, I mean, again, it's debatable when it actually started, but I think
somewhere around.
I think that if we attempt to explain the reasons, I know from my perspective, is that around July, people started figuring out that because there were so many buyers, in order to be competitive, to even have a shot, they needed to be cash, and they needed to be willing to spend way more than the house was listed.
Way more.
And what I found was a lot of buyers weren't willing to do that.
No.
And that may be partially what you're describing with the summer of last year. It'd be 2021.
Right.
And then, of course, this year seemed to coincide with the rising mortgage rates.
Yes.
As that effectively free money began to go away, it became more expensive. Everybody, and of course too, we had all these concerns about what's going to happen. The economy, the gas prices were up and all that. A lot of people, I think, became concerned about what the future holds. Yeah,
when doing a sentiment analysis such as that, the market sentiment is definitely fear-ridden.
Right.
Right now. Yeah, a lot of concern. What's the market going to do? Is it going to crash again? And then the constant conversation we're having with our clients is that they're wanting to wait.
Exactly.
And then when you hear that, I notice a chuckle.
Well, again, I've brought this up in videos. I've said it to people. It's like 6 months ago, you were willing to spend $100,000 more. You just had to have a house.
Yes.
And now, when you actually have a selection of houses, you're not sure if you want to do it. It's just kind of counterintuitive, I think.
It's a human condition.
Yeah.
You want what you can't have.
Yeah.
And you also want what everybody else wants.
Yeah, that herd mentality. Yeah, I mean, I get you.
Now, if you're a buyer watching this or an investor watching this, these are good things to be aware of.
If someone is a true investor, to be able to take advantage of market fluctuations, now is not the time to become overly cautious. Now is the time. Now, the only unknown is what will it look like in 6 months? If the pessimists are right, if 6 months means further price reductions, then technically, I mean, you can get it for, $100,000 off now versus 125.
Yes.
Right?
Yes.
But the expectation that this is going to be some type of like completely devastating economic event where you got like the '08 you referenced. Right. We did not see it here in Texas.
No.
And I think that with coming back to the job growth and the underlying economy, I think it's very highly unrealistic that we could see anything similar to that here.
Right. And any lender will tell you that just because we're in an economic recession doesn't mean we're going to be in a housing market recession.
Exactly.
They're not one and the same.
Yeah.
They don't reflect each other. And I think that the moral of the story here, where I was starting up with talking about last year and this year's shifts, is that we're in an unprecedented time.
Right.
In real estate history.
Right.
Right? So it's no wonder people are scratching their head saying, oh, should I buy now, right? People are spooked, and it makes sense. And then you remember this. It's not timing the market, folks. It's not. It's time in the market. Because let's say you buy a house that costs $300,000, and then all of a sudden the market crashes and that house is worth $100,000, right? How much is that $100,000 house purchased back in 2008? How much is that house worth today? Holy smokes.
I'm not sure I'm following you here.
Sure.
So you buy a $300,000 house.
Yep, and the market crashes. Now it's worth 100, and you're all disappointed, and you're upset. And it's like, oh my gosh, I just lost $200,000 in equity. Doesn't matter. Just wait.
Correct.
Yes.
Exactly. You don't lose the equity until you sell the house. So if you hold on to the house until the values come. Okay, now
time in the market. See, I think in culture, we're too used to instant gratification, right? You order something on your phone that takes 3 seconds, and it takes less than 2 days to get to your house, right? Well, investing, it's all about the mentality, right? You got to get your mind right to be a savvy real estate investor, right? Your best clients, your best investor clients are patient.
Well, to clarify, there is truly a huge difference between a long-term investor and a speculator, because you can make money either way. If somebody went out and bought every house they could possibly buy in November of 2019 and held on to it for a year, they probably could have seen somewhere in the neighborhood of like a 30 to 40% return.
Yes.
I mean, again, that's being able to look back, right? But that's an example of a short term. Whereas somebody, let's say someone who purchased a house in downtown Austin in the 1950s, that over the course of that 60 years, they've seen that value, factor of probably 20?
Unfathomable.
One thing I wanted to touch on. This thing about marketers come up with these names, right? About these different demographic groups. And the theory that I heard, brought up was in the 70s and 80s, the baby boomer generation began to replace the silent generation. That's the generation that fought World War II.
Yeah.
And if you look at historically the state of the economy, the inflation, the interest rates, and all of that, the theory is that a big piece of that was you had a massive segment of the population that reached the point in their lives where they had jobs and started buying things. And that was a huge contributor to the inflation in the 70s and 80s. Now, compare that with today, when you have what they call the millennial generation, who are reaching that time in their life similar to the baby boomers in the 70s. Remember that this younger generation, the millennials, have kind of put off that. They didn't necessarily, as a group, get married at 20 years old. They put it off. They went to school, and they delayed the family. So you have that mass of people who are entering that stage where they have established careers. They may have already started the family, and they start buying things, houses, cars, and everything that comes with it. Yeah. And the theory is because you have a larger group of people trying to buy the things that the previous generation either are still living in, because that's another thing that we're dealing with, is that they weren't selling the homes. So anyway, it was just something that really kind of caught my eye. That'd be a partial explanation of, because as a country, when we had such a massive amount of people entering the market.
Now that's something really interesting to look at. Where did you learn that? Where did you? How did you come to think of it?
Oh, as well. One night it came to me in a dream. No, it was an economist that came out with it. It was one of the news stories I read. Cool. I'll see if I can find
that's pretty cool.
The reference to it.
Yeah, that's really good. Oh, and also comment below if you know the age range between for millennials. What year did you have to be born in to be considered a millennial? Drop a comment below.
I just put the graphic up there, Greg.
Yeah, we got to see if they're paying attention. Okay. Yeah.
So let's do this. Is that we've talked about a lot of different things. Let's talk in terms of what we see coming. Okay, we've talked in terms of it being uncertain. We've talked in terms of, generally speaking, people are somewhat cautious or afraid. What's the vision for? Let's think in terms like an investor. Let's say a 5-year or a 10-year plan. What does this area look like in 5 or 10 years?
Yeah. So this is what I keep hearing. I keep hearing that Q1 and Q2 of next year, possibly into Q2 of next year, is going to be the best time to buy, hands down, for the next 5 years. Okay, they said that we're going to keep seeing price drops up until then. Right now, interest rates. I also keep hearing from different lending institutions that they're going to get up close to the 7s in 2 years' time, and then hopefully 2.5 years from now, they're going to start trickling back down, hovering between 3 and 5%, which apparently is the sweet spot, 3 and 5%. Lenders say that if they're below that, you don't want that. I mean, you do in one way, but in most ways, when talking about the American economy, it's not a good thing.
Well, I mean, I would challenge that thinking only because it's probably a very kind of a short-term memory. If you look at like interest rates over the past 50 years, the average in the last 50 years has been over 6%. You know, I mean, we as a country have enjoyed very low interest rates for what seems like a long period of time, and that's not the norm.
More people need to be aware of that, right? Average is 6%, and they're not really. Sometimes people are getting in the 6s, but it's rare. Today, right now.
Right. Well, I think a huge thing of what we're encountering now is it happens so quickly. It was very much a shock. I mean, the scenario being is that I'm buying a new construction, and I'm approved on the loan, but while the house is being built, the interest rate goes up 3 or 4 percentage points. That could make me unqualified to buy the house.
Seriously.
Now, builders have reacted. Builders are offering promotional rates. Builders, because they want to sell that, keep that person in that house. But those are the types of scenarios when you have that kind of change in a 3 or 4 month period. So we covered a lot of ground. So again, thanks for coming by today. And our contact information is in the video description. If you got any questions, you can reach out to either one of us individually, or if you want to leave comments below. But anyway, thanks again, and we'll get together soon. Until next time. There you go.